A study conducted by the Bank of International Settlements suggests that about 55 to 88% of crypto investors lost money in the last crypto bull market. The study analyzed data on cryptocurrency investors in 95 different countries between the years of 2015 and 2022, noting that about 3/4 of Bitcoin investors lost money on their investments. The number one question you could ask is, why do most people lose money then? And the truth is, there are a variety of reasons why this is so, just like there are in many other types of investments. However, the reason that stands out the most in crypto and in the financial markets generally is risk management. So in this video, we will discuss all of the various ways to manage your risk in crypto investing. Hello and welcome back to Understanding Crypto. My name is Herve, and every other day here we try to decipher crypto to the understanding of everybody. We cover things like predictive analysis, research and tutorials to help guide you through this crazy crypto world. So if that's the type of content you find interesting, click that like button and subscribe to the channel so that you don't miss any other value-packed video like this one. The first way to manage your risk in crypto is portfolio diversification. So simply put, instead of putting all of your investments into one type of cryptocurrency, think about spreading your investments across different assets. This way, if one asset performs poorly, it won't have a big impact on your overall investment. By diversifying your portfolio, you can potentially offset losses with gains of other assets. You can achieve diversification by investing in various cryptocurrencies, including ones like Bitcoin and Ethereum, as well as smaller altcoins. Now, do not only think of diversification as a way of spreading your capital across many cryptos, but across different crypto categories. This includes the likes of smart contract cryptocurrencies, DeFi cryptocurrencies, payment, gaming, storage, AI, interoperability projects, etc. A safe way to go about this is to only invest in the top project in each category. By top, we could be potentially looking at the market cap of that category. It's important to regularly monitor your portfolio and make adjustments when needed. By diversifying your crypto holdings, you can better navigate the ups and downs of the market and reduce your overall risk exposure. Diversifying your portfolio is one thing though, but the problem is, how much do you put per coin or token? Well, this is where we must consider position sizing as a key strategy. Position sizing refers to determining the amount of capital to allocate to each investment based on its risk level and your overall portfolio size. When deciding on position sizes, it is important to assess the risk of each investment and allocate capital accordingly. Generally, the risk in crypto is closely associated with the market cap of the given project. Bitcoin's market cap is regarded as a good reference point to assess how volatile a cryptocurrency's price can be. For higher risk assets such as small market cap altcoins, you may want to allocate a smaller portion of your portfolio to mitigate potential losses. Conversely, for lower risk assets like Bitcoin, you may want to allocate a larger portion of your portfolio. This is actually why Bitcoin's rise or fall in price often brings huge swings of euphoria and fear respectively, because that's the only project most crypto investors can put a larger part of their portfolio in. Now, what's important to note with this sizing is assets of equal risk should take the same portfolio size. For instance, if you are to invest in some meme coins as they go wild on Solana, it would be wise to allocate a certain portion of your overall portfolio in said endeavor. Each meme coin that you would want to be investing in should take the same size of the allocated capital. So if it was 5% of your portfolio allocated for this venture and you want to invest in 5 meme coins, then each meme coin should take 1%. This strategy gives you the best fighting chance in the event where one of those meme coins was to die off, because they do die off a lot of the times. Trust me, I've been there. So assets of equal risk should take the same portfolio size. Never get too greedy and over-invest on the idea of if it only succeeds. And that is what a lot of us think of when we want to invest. We think about the success and we disregard the potential failure that may cause a lot of damage on our portfolios. By carefully sizing your positions, you can manage risk more effectively and protect your portfolio from significant losses. Additionally, regularly reviewing and adjusting your position sizes as market conditions change is essential to managing a balanced and resilient portfolio. Stop-loss orders are a valuable tool for managing risk effectively as well. Essentially, a stop-loss order is an instruction placed with an exchange to sell a cryptocurrency asset when it reaches a specific price. This level is typically set below the current market price, acting as a safety net to limit potential losses if the price of said asset moves against your position. By setting a stop-loss order, you establish a clear exit strategy in case the market takes an unexpected turn. This helps protect your investment capital and prevents significant losses in volatile market conditions. Stop-loss orders are especially beneficial for traders who may not always be actively monitoring the market. However, it's important to set stop-loss levels thoughtfully, considering factors like price volatility, market trends, and your risk tolerance. Overall, incorporating stop-loss orders in your trading strategy can help provide peace of mind and help you navigate the crypto market with greater confidence. Now, it's important to note that this applies a lot more to trading rather than investing. So if you're investing for the long term, well, you should be ready to buy dips instead. If you are convinced that an asset will go perhaps 100 times its current market value, then you should just be ready to buy the dips when it does dip, because it will have dips. Unlike stop-loss orders, which are designed to limit losses, take-profit orders are aimed at securing gains. When placing a take-profit order, traders specify a target price at which they want to sell their asset to capitalize on favorable market movements. Once a cryptocurrency's price reaches or surpasses said level, the exchange automatically executes the sale, allowing the trader to realize their profit without needing to actively monitor the market. Take-profit orders are particularly useful for traders who may not always be there to actively monitor the market. So if you are not always there to monitor the market, you may place a take-profit order or a stop-loss order. By setting clear take-profit targets in advance, traders can avoid the temptation to hold onto assets for too long and potentially miss out on profit-taking opportunities. However, it is also essential to set take-profit targets thoughtfully as well. I will leave my video up in the top right here on how to set take-profit targets and how to set stop-loss orders using Fibonacci. Now, what you cannot afford to make your paramount standard when trying to manage risk in investing or just intraday trading is risk to reward ratio. This is something you may have heard of before but wondered what the hell it actually meant. Simply put, the risk to reward ratio is a fundamental concept in trading that quantifies the relationship between potential profit and the potential loss of a trade. It provides traders with a way to assess the potential return relative to the risk undertaken. The ratio is typically expressed as a numerical value calculated by dividing the potential reward of a trade by its potential risk. For instance, let's say you are considering a trade where the potential profit is $200 and the potential loss is $100. In this case, the risk to reward ratio will be calculated by dividing the $200 by the $100. $200 being the potential reward and $100 being the potential loss. And the result of this division is 2. A risk to reward ratio of 2 here means that for every single dollar you risk, there is a potential to gain $2. It's often expressed as a ratio such as 1:2, indicating that for every unit of risk, there is a potential for twice the reward. Traders and investors alike typically aim to have a favorable risk-to-reward ratio, where the potential reward outweighs the potential risk. This ratio helps traders and investors assess whether a trade or an investment is worth taking based on the potential payoff relative to the amount of risk involved. A higher risk-to-reward ratio suggests a favorable trade or investment setup, as it indicates the potential for greater profits relative to the risk undertaken. By using the risk-to-reward ratio metric, you make more informed decisions, manage risk effectively, and optimize your trading outcomes over the long term. It's important to note, though, that crypto is extremely risky. So when investing, you should always be aware of the fact that it could all come down crashing miserably. So do not invest in crypto what you cannot afford to lose. Stay up to date and follow the latest trends and updates, which you can do by following this account with your notifications on. Another thing to have in check is your emotional state. Most of your losses will purely come from your fear or your greed. Remain level-headed and have a longer-term perspective. You may get lucky, but building wealth takes time. Periodically review your portfolio and investment or trading strategy as the markets change always, so it's imperative to change with it. Thanks so much for watching this video. If you did enjoy it, please give it a like. If you are not subscribed to the channel already, do so with your notifications on so that you don't get to miss the next video. If there are other ways to manage risk which I failed to mention in this video, let me know in the comments. And if you want to learn some of my trading techniques and methods, I will leave some of those videos on the screen for you. But until the next one, stay safe.